Investment Officer at Heritage Capital. Paul, good to speak with you. You say that Apple could decline 50 to 80% from its all-time highs, which could imply about $150 lower from where we close in today's session. That's a nice headline, but walk us through how you get there.
Sure. So this is not new as I woke up today. This was on the way up. To me, every bull market in history, you can go back to the dot-com bubble, you can go back to the 1920s. Every bull market has a story stock or a few story stocks. They become ingrained in our investing fiber. They can do no wrong. Everybody must own them. Apple became the story stock of the post-financial crisis bull market. When Apple peaks, it's not just Apple. I mean, this is what happened with Google in 07, went down 66%, and Yahoo and GE with the dot-com bubble burst, and on and on. So whenever the next bear market comes, which I think probably begins sometime later this year, you know, Apple's going to get taken apart. It started a little earlier because we're still, frankly, I think we're still in a bull market.
Hold on.
But this is what happens.
How do we get to a decline of 50 to 80% from its highs, though? That's what I'm wondering. How do you come up with that calculation, that percentage decline?
It's simply based on historic research of every story stock in history. The bear markets are very unkind. They punish the people who came in late. So if you look at a chart of Apple, the last big move, the real acceleration started at about 400 and accelerated almost vertically to 705. So to me, if history is any guide, you wipe out a minimum of all the people that came on during the acceleration, the real high Momo phase. So that's at least gets me under 400. And if you use the 50 to 80%, you get somewhere between 300 and 400.
Right.
I'm not saying Apple's done. It's a wonderful company, fantastic products. It'll be around forever. But I think Apple's best growth days are certainly behind it, just like GE's best growth days were in the 90s.
You make
it's still a great company.
You make a lot of interesting arguments, Paul. You seem like a nice guy. You seem like you know what you're doing. But at the same time, you're not putting your money where your mouth is. I mean, are you short Apple at this point? Because if it is a 50 to 80% decline from 705 or so, then I would think that this would be a slam dunk of a trade from your standpoint.
No, and disclosure, we have no position in Apple long or short. I take a sector view and a more index view of investing and trading. But Apple's certainly the story stock, and it's the bellwether stock for technology. And to me, technology, the best days of this bull market for tech are over. And I think Apple's one of the clear reasons why. I know the story with Dell today, and hopefully that gives us a little legs for the next couple of weeks. But I think tech is going to, best case, perform with the market. And I think second half this year, tech's a clear underperformer.
Paul, real quick, the one hole I'd put in the argument you put up as far as Apple's concerned is valuation. When you talk about some of these other tech names over the past, we're talking about extreme valuation levels that they reached that seemed a little bit exuberant. You can't say that about Apple, even at 700, but particularly now at 500. So what is it about Apple right now that you think completely loses all the mojo, and why would investors not want to start piling in? We've heard from Leon Cooperman, some of these very smart investors who've been out of the money, put selling for a while now, wanting to get positions on if this were to break below 500. So why is it that we would break all the way down towards that 350 level?
And I don't think it happens right now. I think at some point you're going to get a $100 rally in Apple. To me, that's a rally to sell Apple and sell tech more than to buy. And I think that I don't think it goes down to 460 in the short term. I think maybe the break is to maybe 495, 490, 485. But the valuation question, let's not forget, in 06 and 07, the financial stocks and the home builders, they had PEs in the single digits, and they still went down 50 to 90%. Cheap can get cheaper. This could be a value trap. Listen, a lot of the high-level fundamentals are way above my pay grade. I'm looking at history, and history says this is likely where the stock is heading over the next 1 to 2 years.
All right, Paul, we're going to leave it there. Good to speak with you.
Thank you.
Paul Schatz.